This signal rarely matters immediately, but when it does, it changes how fast the next phase arrives. And by the end, our strategy will know which tickers tend to react first. In our strategy, risk is tracked through a 5-phase cycle. The focus is sequencing, not prediction. Optionality matters more than conviction. This episode reviews a thoughtful money conversation with Stephanie Pomboy. The discussion covers precious metals, policy, housing, rates, and global funding risk. Watching the full original adds valuable context. Markets can look calm while the system becomes more fragile. That is the tension here. Strong headlines versus unstable mechanics. The claim is that metals are not just rallying. Behavior is shifting toward physical delivery. That is a plumbing signal, not just a price signal. Paper claims can expand quickly. Physical supply cannot. When delivery demand rises, the bottleneck becomes real inventory. Here is what most people miss. The metals move is also a confidence move. Confidence shifts before fundamentals finish adjusting. This signal lives in dollar funding and reserve behavior. It also sits inside geopolitical policy pressure, and it feeds into inflation through commodities. If reserves can be frozen, incentives change. More buyers prefer assets that are not someone else's liability. That pushes demand toward gold as a monetary asset. In the Curtis-Fornera framework, this raises Phase 2 probability modestly. It does not confirm Phase 3. But it increases sensitivity to shocks. Affordability policies aim to lift the bottom of the K-shaped economy, but interventions can create unintended consequences. That friction matters for markets. If returns are capped, lenders tighten standards, credit becomes harder to access at the margin. Risk migrates into less visible channels. Hold this thought. This matters for timing. Policy can support growth while destabilizing markets. That combination often precedes Phase 2 behavior. Mortgage support may offset tightening rather than lower rates. If rates do not fall, prices become the release valve. That weakens the wealth effect. Easier policy language does not guarantee lower long yields. If term premium rises, valuations compress. Growth alone does not prevent that. Japan illustrates an external tightening risk. Currency defense can force dollar selling. That can translate into treasury pressure. This is where it becomes actionable. Our strategy shifts from narrative watching to signal watching, and the signal stack sets the pace. Before this signal set, Phase 2 risk sat in a moderate range. These dynamics nudge that probability higher. Not certain, but closer. This is not a buy window environment. It is approaching a ladder watch zone in parts of the market. Still early, but no longer distant. Quick disclaimer, this is educational macro commentary, not financial advice. These are not buys. These are the tickers most sensitive if this persists. TLT reflects first duration sensitivity. ZROZ responds later, only after yield confirmation. SPI reflects broad risk conditions. SMH and AIQ and chat capture high beta liquidity exposure. Breadth matters more than headlines here. Gold and silver track monetary confidence. Oil adds resource and inflation sensitivity. EEM reflects global stress and dollar constraints. Phase 2, pressure rises. Exit discipline tightens. Sequencing becomes more important than boldness. No single signal flips the entire framework. Confirmation matters more than anticipation. Optionality remains a strategic asset. Which signal breaks first, credit or long yields? Are you seeing confirmation yet, or does it still feel early? Our strategy does not need to be early. Our strategy just cannot afford to be late.